Hey everybody, welcome to this free edition of our Trader Use Group weekly roundup for the trading week ending November the 11th, 2022. I'm Preston Britton. Thanks for tuning in. Well, this week's theme, we have a launch, but is there enough fuel to get us escape velocity? Well, let's kind of take a look at where we've been. I mean, this has been one heck of a week, strong week. It's not surprising with the way the inflationary data came in. If you look at the week, everybody was solid in the green by a good amount. Look at NASDAQ up over 8.1%, right? A lot of it was because of the CPI data that hit Thursday. And NASDAQ, I think it recorded its largest gain since April of 2020. It's one of the largest single day moves in NASDAQ in quite some time. But keep in mind, of the 20 largest moves in NASDAQ over the past 50 years, 80% of them have occurred in bear markets. So you get a lot of shorts in there, and then you get the short running, and next thing you know, you got a big move. So we've got to look at this and be very careful, but you can see how everybody is moving. Year-to-date, NASDAQ still down, even after that 8% move up this week, 27.62%. The Dow is leading the charge at 7.13%, and it's no surprise because the Dow is composed primarily of energy and industrial, some materials, commodities. So those tend to be doing very well right now. NASDAQ with technology is the one getting crushed. If you look at the PE ratio, the Ford is 17.72. I know some others call it 16, a little in the high 16s. The dividend yield is 1.68. 10-year Treasury backed off of its number over 4% and fell 3.81%, but it's still 213 basis points higher than the dividend yield in the S&P. Now, the earnings yield for the S&P is 5.7%. And if you compare it to the 10-year Treasury, the earnings yield is almost 1.9% higher. But when you kick in inflation, it's still a negative 2.2%. So the Fed still have a lot that they need to do, okay? Like I said, CPI headline data this Thursday rose 40 basis points month over month, but it was less than the consensus of 60 basis points. So what that did was it brought the year-over-year inflation increase to 7.7%. That's a pretty good drop from the prior month. It was the slowest increase that we've had since January this year, inflation-wise, on the headline number. Now, core inflation, which is what the Feds watch, and what they use as the driver, because core inflation, you take out food and energy, and why they take out in food and energy, I'll never know. Well, they just want to keep a lower number, because what family doesn't get food? What family doesn't use some form of energy to get wherever they're going? But anyway, year over year core came in at 6.3%. That was from 6.6% in September. So that's all we needed, and the markets just took off, right? It was just a huge rally. Almost all of the rally happened on Thursday and Friday for the entire week. Okay. Now we did get a little bit of sour news. University of Michigan's preliminary gauge of November consumer sentiment, it fell to the lowest level since July. Okay, so it did come down. But as I also said, that lower than expected inflation reading, both headline and core, also spurred a very intense rally in risk assets, as you can see on the screen there. And the 10-year Treasury yield ended at 3.81%. It was over 4.17 the previous week. So that's a big drop. So it was definitely a risk on market here. Okay. The other thing that I saw was even junk corporate bonds rallied with equity. So everybody was having a good week this past week. Okay. Now, if we come over and we look at Europe and just kind of see across the pond how they're doing, everybody was in the green. The Euro stocks was up solid 4.8%. Everybody's still in the red year to date. The FTSE, CAC 40, DAX, all in the red year to date, all in the green for this week. Shares in Europe, they were up, even, and inflation is still very strong across Europe. Okay. But everybody was reacting to the CPI data and the U.S. Feds not having the pressure that they had going into this meeting anyway of being very aggressive. Now, the Feds are still going to hike. There's talk of another 50 basis point rate hike on December the 14th. But outside of that, most of the market feels that there's going to be a pause by the Feds early next year. So that can give the markets a chance to digest this huge rate of change from 0 to almost 5% in less than a year with the Fed hike. So we'll see how that thing fares itself out. Meanwhile, over in Europe, like I said, Great Britain, their GDP fell for the third quarter. It looks like they're going to have a pretty good, strong recession. In the European Commission, they forecast Eurozone economy is going to contract in the final quarter of this year by 50 basis points and then shrink further in Q1 of next year. So it would make it a technical recession, much like what we had, primarily because of higher energy prices. And if they have a cold winter, it's going to be even worse. And they're also showing economic growth across Europe is predicted to slow to 30 basis points for the year now, not for the quarter, but for the year. And they raised their inflation forecast 8.5% for this year, 6.1%, coming down just a little bit, but still fairly aggressive at 6.1 next year, and then finally falling off the table in 2024. We'll see, but the markets are not out of this pickle yet, folks. Just understand that. And then, of course, if we go over the Asian markets, you can see Nikkei, China, and Hang Seng all in the green. Hang Seng had a really good solid bounce because they really fell hard. They're still down 25, almost 26% for the year. In Japan, equities moved higher. Sentiment is kind of lower than expected U.S. CPI data. So that helped them also. And the Bank of Japan also reasserted that they're going to retain an ultra loose monetary policy. So like I tell our members, Japan is it's really not a true market, market forces, supply and demand. You've got the government in there as a major buyer, so they kind of screw up the equilibrium between supply and demand. So it's not, in my mind, a real good market to gauge on. And then, of course, in China, I saw this past week another surge in COVID cases. So the number of daily cases reaching over 10,000 for the first time in a year. So that can threaten further lockdowns in other cities, although they're trying to get away from that zero COVID policy because it's really weakened their economy. I mean, their exports fell 30 basis points in October, well below they had estimated a 4.3% increase. So that's 4.6% miss in their exports. So that just means Europe and the US aren't ordering as much. Imports also fell. So the Chinese consumer is not buying a lot of stuff either. Fell 70 basis points. So they're in a pickle over in China as well. All right. So that's a little bit about what I see there. I'm going to switch you guys over to the E-mini S&P 500 futures. Let's get over here. And I'm going to show you where we're sitting here. And generally when you get a market like we had this past week when it's to the moon, you need to sometimes just take a step back and take a look at stuff. If you look at this daily chart, you can see I've got a shaded zone right up here, which we ran right into. And that shaded zone is very simple. It hit these prior pivot highs. All right, and then we can run. Oh, well, sorry, that's the wrong one, but it looks very similar. Let me get the E-mini S&P 500 futures on because it looks very similar. And a lot of these stocks do look very similar to the E-minis, by the way. So if you look at this, you can see here this was a minor prior pivot high, but this is going to be the big one right up here. All right, it's at the 23.6 fib node, roughly 41.75, but we got to get over the 200 EMA, which is sitting at 40.80. So as I've told our members, right in this area here, I do see a lot of traffic and a lot of overhead resistance. But the key for me is the bear market over, or is this just a bull trap in a bear market rally? You can see these big pivot points, and I'm going to show you another chart of it in just 1 second. But what I want to do now is just get this over here like this and show you. You can see here. Well, let me just get my pen on. That would help, wouldn't it? Let me get my pen turned on. In fact, I'll use my highlighter because it'll stand out more. If I were to draw that line down, it looks like that, right? So you got a key pivot point here and a key pivot point here. These are minors. These are just minor pivot points. That is going to be key. And notice that yellow line is going right down that line, that trend line. That yellow line is the 200 EMA. That is going to be our next big hurdle, right around, let's call it 4080 to 4100. And then we got another fib node sitting right up above that. So there's going to be a ton of resistance there until or unless we take that pivot point out, right? Right there, or that trend line out rather, and then we get resistance and then find support at that trend line and then move higher, then I want this pivot point right here, sitting right at 4,300. I don't think we're going to hit it, guys, before the end of the year. I think it may come up and challenge it. It won't be a straight line, but I don't think we're going to hit it. I think it's going to roll back over. We'll finish probably a little bit higher than where we are now. I've been telling our members off of this low right here that we had called and forecasted. Remember, I had a range down here of 3,500 to 3,400 as evidenced by this colored bar right here, and we came down and hit 3502 in the E-mini S&P 500 futures, right? It was on October the 13th that we hit that number. So I do believe we're not going to go below that number before the end of this year. And then in February, March timeframe, we're going to start another journey back to this downside. We'll make a final low, and then it'll be choppy but channel to the upside through the end of 23 into 24. Now that makes a lot of assumptions, and as you guys know the saying, any trader that follows the crystal ball usually ends up eating a lot of glass. I like the saying, but what we do is we put a lot of data together on various charts. We look at the rotation, we see what the sectors are doing in different stocks at different times, and we come up with a pretty good idea of where the market's going to find support and resistance. So far this year, we're up over 17, 18% year to date, while everybody else is underwater. The only asset that's up are commodities and primarily oil. So this is the E-mini. Now, if we look at the S&P, if we look at it on a weekly chart, you'll see here, weekly chart of the cash index, SPX. And you can see here, this red line is the 200 SMA, roughly. Okay, and this yellow line is of a daily chart. This yellow line is a 200 EMA of the weekly. So it's the equivalent of about 1,000 EMA. And you can see whenever you go below that, it starts to get very ugly from a bear market standpoint. Just to prove my point, I'll show you. If we just back it out a little bit, you can see right here, this was the COVID crash. Notice down here provided support. And if I back it out again a little bit further, notice back over here in 2016, it provided support. And the last time we really went and we found support here in 2011, but the last time we really went through it was 08 and 09. That's an extended right here. And it's a good marker, guys, to use just to say, is this going to get really ugly or not? Right? So going all the way back to 2011, the 200, if you put a 200 EMA on a weekly chart, it'll give you a pretty good idea. Or you could do 1,000 EMA on a daily chart. This is long term. You can see here how we blew through it, but that was a kind of a flash crash, COVID kind of thing, and those very, very rarely happen, right? I mean, I think it's the first time I remember shutting the government down. But outside of that, you can see here where we actually have been coming down and we hit right below it, but we quickly regained it. And now we're back into this symmetrical triangle right now. Okay. So these are the overhead resistance. But like I said, that one right here, the B wave on the Elliott wave, that's going to be a key number. Right around 4,300, a little bit over 4,300. All right. It's got to get up over the 200 EMA, which is this red line. And once it does that, and it finds support here, I'll change my tune. But right now, this is just a very strong rally in a bear market. All right. If we look at the rally distance, let me just move this out a little bit just to show you that it can be very deceiving, right? So if we look at the rally distance, let me just get this on the screen right here like this. Let's do this. So the rally distance here was about 12%. The rally distance here was about 18, right at, call it 19%. So the rally here is only at, right now, we're only at 14%, right? These are big rallies, counter trend rallies in a bear market. A 12.5% rally, almost a 19% rally, and now we're only at a 14% rally. So we can still have a another 5 or 6% before we get to that 50 or 200 EMA, and then we can roll back over again. So just understand the markets that you're in, all right? Things can change very quickly. Now, if we come back over here and we look at volatility, let me just sort this a little bit. If we look at the VIX, you can see the VIX came down hard over the past couple of days. Look at this, it fell out of bed. But we're still in the red zone. Until we get below 20, then the markets are going to stay very choppy every single day, right? And it's this entire year, every time we get over 30, the trade has been to short VIX or short volatility, because it drops off the table. But then once it gets down around this 20 level, go long volatility. It's been like this the entire year, right? This is a yearly snapshot of where we've seen with the VIX, and that's kind of what we're looking at, right? Now, if we come down here and we look at treasuries, look at the bond market. Bond market, you can see here, it fell through my target, but it's going to rally back up, all right? But I do believe it's going to come back down once it gets up in this area here, because they're not done raising rates, all right? This is just one day. The CPI was one data point. We're going to need to see multiple ones for the Feds to back off of their hard stance. But we've already seen the markets are pricing in about an 80% shot of a 50 basis point rate hike in December versus a 75 basis point rate hike. So that's a little bit of what I'm seeing there. And look at the dollar. It's also come off the table. I told our members about going long the euro. Look at that. That is capitulation right there. Poof, away we go. I think it can go down a little bit lower, and then we're going to get a bit of a rally, and then you're going to sell into it. Because if you look at the euro, it moved very strong. I've been telling our members, we got a nice trade setup routine in the euro, and you could see this move right here. We blew right through the 50 EMA. This is the first time we extended above the 50 EMA. Remember, our target for the euro is to get back over 101 and then go long, okay? And that was the trade. It's probably going to hold up a little bit at the 200 EMA, but the target is for it to go way back up higher. So playing the euro long, and remember, currencies tend to trend. It's where you want to be. The British pound also moved up, right? Not quite as strong as the euro. I prefer the euro long rather than the British pound. So those are just real quickly some of the things that I've gone over with our members. The other thing I like, copper. Now, copper, it took off because lower interest rates, or the trajectory of interest rate increases being less aggressive, is bullish for copper. Copper is a global commodity. So when it looks like the planet is going to do fairly good, then copper does good. The other thing driving copper higher, however, is there is a big global shortage of copper. So if there's a lot of infrastructure spending like China wants to do, then that tends to boost copper. My target for copper was actually out here, much lower over a period of time. So I'm not really ready, nor am I convinced that this level up here in copper is going to hold. We'll see. Gold, this one had a strong day on Friday. We cleared the 200 EMA. One thing about gold is it follows the technicals very well. We actually came very close to my target. My target was right at about in the middle. My target range was actually 1614 down to about 1600. We hit 1618, so we came very close to my target. Now, as you can see, we've bounced over the 50, over the 200. I think if we can climb and keep this momentum, because remember, I said over 1740, you want to look at longs in gold. And that's kind of what we're seeing right here. I think that could be a nice little play. Or silver. Oil, I think, is going to creep higher. Friday was a good day and a risk off. It took off a little bit over 2 or 3 points. But I think oil, and we've got ways to trade oil. We've got members that are making nice money in oil. I think this thing is going to slowly move up as well, right? So that's a little bit about where I'm seeing that take off at this point in time. Let me just see here if there's any other. Nat gas, also nat gas. I think natural gas. Our shorts were up in this area here, both of them. These were great shorts. It was low-hanging fruit. I think nat gas will slowly come down, even though there's strong demand. Remember, nat gas is still elevated, even at these price levels. It's elevated, okay? So that's a very quick and dirty view of a lot of major asset classes based on this week's movement. Members, I will see you this Sunday evening. We got a lot more detail to go through with different potential trades. If you're not a member, I highly encourage you to come in and check us out. We're doing very well this year. Next year is going to be even more promising. Other than that, guys, enjoy the weekend. Members, I'll see you Sunday evening. Ciao, folks.